Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. And welcome back for another episode. My name is Michael Hefner. I will be your host for today's episode of Integrated Insights. I'm joined by a couple of the team members and my coworkers, Andrew McQuilkin and Mason McFarland. Welcome, guys.
Thank you.
Thanks.
Today we're going to be talking about valuation strategies, art or science. And so to get started, let's just talk about what do we mean when we say valuation, and what are the current methods used today?
Well, first let's explain how this is different from a business evaluation or valuation that you kind of hear about, because I think owners come in and they say, I've got a valuation on my business, and that's not what we're talking about today. We're talking about when you come to us to sell your company, we look at three different approaches that are used in evaluation of your business. So there's an asset approach, which I would say is typically used if your company has equipment, trucks, all that kind of stuff. If that exceeds the value of your business or what's on your bottom line and a multiple of that, that's typically when you would use an asset approach. And then there's the market approach, which is typically what we see and what we use. And I think there's a lot of things that affect it, but basically it's using the EBITDA, or the earnings before interest, taxes, depreciation, basing the value off of some sort of multiple of that. And I think the factors are, economic factors, industry trends, all that kind of stuff. It's what buyers are willing to pay for certain industries kind of sets that multiple and that valuation. And then there's the future income approach, which we don't work a lot with, but it's basically if you've got contracts Andrew, do you want to speak to that?
Yeah, the future income it's about the predictability of the sales, or predictability of the cash flow of the business. And so if it is heavily subscription, right? Software as a service, SaaS companies are notorious for this method just because it is extremely predictable. And you have people sign up for months and months and months, maybe years, and it's heavily predicted. And so you kind of it's a similar to market approach, but it kind of maybe even a multiple of the revenue, right? So where we have come across this mostly, the majority of the time whenever we do use it, really is in pest control. Right. And so you think about not the termite side, not the, hey, I've got a raccoon in my chimney, I got to get it out. Not that side. It's the recurring maintenance. Hey, I'm going to spray for every quarter, every month, or whatever, treatment, that kind of side. That's predictable. And so we use this and look, all the valuation methods, it all revolves around what kind of return there's going to be in the company, right? If you buy this company, it's all about how long am I going to get my investment back, right? And so for same thing with the market approach, where you're putting a multiple. That multiple is based on the kind of return that you're going to make. And so I know we've done a couple videos on this. I think that we can research a past video that we can drop where even I think Grant and Dave they speak to this of just kind of the return side of things in the valuation. But that's essentially what we're trying to do, and there are several factors into all three approaches, right?
So I know, like, for the asset approach, we talked about when assets are worth more than the business. Is it that black and white? Is every business different? What other factors kind of contribute? You said that we don't really use the future income approach much, but is it that black and white asset approach versus market approach?
Yeah, I would say it's probably more black and white than it is gray, but at the same time, I mean, look, we actually look at both approaches, right? So we look at what is the cash flow, and if it's not cash flowing at all, then well, it's probably going to be an asset approach, right? If just because it's not producing, so if you try to put a multiple on that and that net number, you end up with a negative, right? And so it's worth what you're going to. It's more of the replacement cost, right, of buying the assets that you have, right? It's heavy equipment type of businesses, and so that's when you decide it is an asset. When I say we look at both. Let's say a company is I'm just going to use numbers that I can compute, but the net number is 100,000, right? And that's the number that we're going to put a multiple on. Let's say that multiple is 3 times, so it's a $300,000 company. But if the assets are much greater than that, then we would, if I say, and I'll also say net assets, right? So that means the value of your equipment, right, minus all what you owe on it, right? And so that's what that net assets are, and you kind of look at that. Okay, well, that is 750,000. Okay, well, then now you're looking at I mean, if you sell all your equipment, then you're going to get $450,000 more than you would if you sold the company just based on market approach.
Yeah, Andrew, I love that you brought up net assets there, because I think that's really important to highlight in that original explanation of the asset approach, because it's not just the assets are more than the business, but it's the net assets are more than the net of the entity. So the tax structure can impact that, and we would have dug into that more on the structure episode that Grant was on previously. But I think that's really important for our listeners to hear. Another thing that you also mentioned there, Andrew, though, was the multiple that is applied. So let's dig into that a little bit more, because I know even internally when we're trying to evaluate a business's current standing, one of the things that we do is we do some research. We figure out, hey, in that industry, what is kind of the range? What's the spectrum of multiples that we see? So what can affect where a business lands on that multiple spectrum?
Yeah, there are a lot of things that can affect it. I think one, just the overall business's reputation. I think having a lot of products and services with a steady revenue stream can affect it positively. Having an experienced management team and not being dependent on the owner to be able to run it, that would increase the multiple, and you would get a higher end on the multiple range. Just a buyer looking at, does this business have growth opportunities as well? Those are just a few things that can affect the multiple in a positive way as a buyer's looking at it.
Yeah, and I would say, I mean, the factors, there are a lot of them, and that's why we dive in pretty deep so that we can know what the factors are, right? So there are the discounts to it, right? If it is heavily dependent on the owner, like Mason said, but there are very specific ones that we have to dive into, and that's why we're going to ask you a ton of questions. right? And so, and I would also say, I mean, there are ways that we could talk through it, and even hopefully really kind of almost advise you to fix it before you take it to the market, so that you can up your value, right? And there's several ways to do it. It's not just I need to be increasing. I need to increase it a little bit more. It's not just about that. It is about a lot of these different factors. It's about the profile, the overall profile. And so we will dive into just to look at all of those factors. And that said, I mean, there's even in each market, there is its own range, right? And those that are in the construction industry, they're not trading at the same level of a aerospace and defense company, we'll say, right? Or even a healthcare company. They're not the same. And so the ranges are, it could be, hey, we're going to be at 3 to 4.5. And then we're going to be at 7 to 9. Right. And so it really is, it's going to depend on that, and then we go into the details of where you are in that specific range too.
That's great. Andrew, going to put you on the spot for a second. I know something else we look at when we're trying to determine, hey, what is the value of this company and applying an EBITDA, all that. We also look at the way to look at, trends, how they're doing. Some of it's just like an average of the last 3 years. Some of it's weighted. How do we come to a decision on that? What impacts if it's weighted versus average versus just the last year?
Yeah, that argument for what the multiple is going to be on, right? We say multiple of EBITDA. What is that EBITDA, right? And so, and it's not just a one calculation. I mean, there are adjustments that we may make, right? One-time expenses that aren't normal or really abnormal expenses. Maybe it's, hey, this happened in this company this last year. That's not going to happen for another 10 years, whatever it is. Right. So, they just did this, big, repair in the building or to some of their equipment or whatever that looks like. But we have to adjust some of that kind of stuff, and really that's the first thing that we'll do, right? And then we'll also say, okay, what is the like you mentioned, average. The weighted average is what we say a lot of times. So that means we kind of look at the last 3 years. This is one quick formula that we'll do, but we'll take we'll take 50% of this most recent 12 months, 30% of the previous 12 months, and then we'll take 20% of that the previous to that one. And so we kind of take that, and that is what the multiple would be on. That's one way of calculating a weighted average, if you will. We will it really just depends on several different things, but yes, trend is a big one. A lot of companies after COVID, they declined and they showed that kind of trend. And we kept on walking through what it would look like if you showed a hockey stick. All right, and the longer that you get that hockey stick, the more more likely the method would change in or what EBITDA we're using. Is it a trailing 12 month? Is it a weighted? Is it just a straight average? What does that look like? And so I would say, honestly, most companies that are trending upwards and they are pretty stable, they are growing, and there's a pretty solid profile of the company. I would say that it's I have seen most commonly that it's a multiple of a trailing 12 month. If there's seasonality, if there is kind of up and down growth or an up and down trend, then I would say we've seen a weighted average. We've seen an average. It just that's what I've experienced, and this may not be the case for everyone, but what I have experienced in the last few years has been more of, if it's up and down, but there's still kind of a almost, you put over several years worth, and there's still kind of a linear growth, but it's just going like this. It's probably going to be a weighted average, because you put a little bit more weight on what has most recently happened, right? And so if it's just straight up and down, that's when we would say an average. If there is even a decline and a hockey stick growth, we probably would do an average then, because we know that it's trending back up. That's a lot of people after COVID. That's what they kind of looked at. But the further along they got, where they showed that growth up, they would more likely be just a trailing 12-month EBITDA. And so that's I mean, it really depends on the buyer. Buyers differ. I mean, for one deal, I think I had 5 different methods on how they calculated the EBITDA to put a multiple on. So it really, you just don't know a lot of times, but yeah, most commonly trailing 12.
Well, before we wrap up, just a quick message to our listeners. One thing that you can do to get to start positively impacting that multiple today is to get your house in order. Make sure your finances are tight. Make sure they're consistent. Grant has said on the podcast before that it's better to be consistent than right. So get somebody, whether you got to outsource it or you have someone in-house that you trust, get those financials in order so that trends can be seen and that you can get the most for what your situation truly is. So,
look, I think that it's an advisor has the ability to point out a lot of the negatives, right? And points out the positives, but the main thing is, let's point out the negatives so that we can maybe change some of those things. That's a big reason of why you come in advance.
Yeah, not to question the trust of business owners, but sometimes just because you have a trusted advisor doesn't mean they should be trusted, right? So if you have that question, you say, hey, I have someone managing it, but I don't know if it's managed the way it should be. Like, we're happy to sit down with you, look over those financials, kind of tell you what you're looking at and where some changes may need to happen. So awesome. Well, Andrew, Mason, thanks for joining me today. That's all the time we got.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.